We've talked before about what an installment agreement is and how it's making payments over a period of time to pay the balance due to the IRS in monthly payments. Well, sometimes a person can make a monthly payment, but they can't pay enough to pay off the amount that is fully owed. And there's a statute of limitations on how long the IRS has to collect money. So they've got to collect all the money within 10 years of the time when the tax was assessed. So you've got an assessment on the books. They've got 10 years to collect it. If the 10 years runs out and it's not fully paid, the rest of that money cannot be collected. So sometimes the IRS will look at it and say, well, look, from the government's point of view, we're better off to get what we can, even if it can't be the full amount. Well, there was a period in time when the IRS couldn't do that. So it was brought into the law back in, I think, 2004, 5, 6, somewhere in that area, where the IRS can now take partial payments. So that's what we call a PPIA, partial pay installment agreement. And it's where someone's making monthly payments toward what they owe, but they will not full pay the amount they owe within the 10-year statute of limitations on collection. And it can end up being a way for a taxpayer to keep the IRS from doing enforced collection activity because they're paying as much as they can afford, and it kind of protects the taxpayer, but it gives the government at least something toward what is owed by that taxpayer. And it's usually done with a financial analysis where the IRS will look over the income figures and the expense figures of the taxpayer to determine if the amount they're paying is adequate. So that's what a partial pay installment agreement, or PPIA, is all about.